Good morning, children. This is part 8 of the chapter Admission of a Partner. In this part, we are going to discuss about accounting treatment of reserves, undistributed profits, and accumulated profits or losses. Undistributed profits or accumulated profits or losses means that part of profit or loss or reserves which have been kept undistributed. That means they have still not been distributed among the partners. So, just like there might be goodwill appearing in the books before the admission or at the time of admission given in the balance sheet, in the similar manner, you might get reserves or undistributed profits or accumulated losses given in the balance sheet at the time of the admission. So the treatment for this is same like goodwill given at the time of admission. Just like we used to write off the goodwill among all the old partners in the old ratio, in the similar manner, we have to distribute all the undistributed profit or any type of reserve, be it general reserve or reserve fund, etc., or any kind of accumulated losses among all the old partners in the old ratio. In this case also, we do not have to discriminate or differentiate whether the partner is sacrificing or not. No. All the accumulated profits and losses will be distributed to all the old partners in their old ratio, whether they are sacrificing or gaining, irrespective. So as you can see, at the time of admission of a partner, if there is any general reserve, reserve fund or the balances of profit and loss account appearing in the balance sheet, the reserve may be given to you by the name of general reserve or reserve fund or the balance of profit and loss account. For example, an item must be mentioned as PL account, credit or debit balance, appearing in the balance sheet. It should be transferred to old partners' capital or current account in their old profit sharing ratio. It will be transferred to old partners' capital account if it is a fluctuating method and current account if it is a fixed method. And as you can see what is written in the brackets, new partner does not share in these reserves. Reason being that these reserves are the result of the work or hard work of the old partners. Therefore, it needs to be distributed among the old partners only. For this purpose, the following journal entries are passed. The first transaction or the entry, which is for transfer of reserves and undistributed profit. Reserves may be given to you by the name of general reserve or workman compensation reserve or reserve fund or investment fluctuation reserve, etc., or undistributed profit may be given to you as the credit balance of profit and loss account. If it is a credit balance of profit and loss account, then it will be an undistributed profit. But if it is a debit balance of profit and loss account, then in that case it will be an undistributed loss. So if the credit balance of PL account is given, then only it will be treated as undistributed profit, or else if the balance is not mentioned to you, whether it is credit or debit, then in that case you have to see whether it is given on the liability side of the balance sheet or the asset side of the balance sheet. If the profit and loss account balance is given on the liability side of the balance sheet, then it is treated as the credit balance, that means accumulated profit or undistributed profit. But if profit and loss account balance is given on the asset side, then in that case it is treated as a debit balance of PL account or profit and loss account, which reflects the accumulated losses. So let us have a look at the entry for transfer of reserves and undistributed profits. First understand the logic, then we will see the entry. So any kind of profits or reserves carry a credit balance. So when you will be distributing it among the partners, that means you are clearing it, wiping it off from your books. So if it is having a credit balance, and when you are distributing, when you are removing it, then it will carry an opposite balance so as to close itself. So therefore, while distributing, the accumulated or the undistributed profit and any kind of reserve which you are distributing will carry a debit balance. And when you will be giving these profits to the partners, whether in their capital or in their current account, it will increase their capital or current balance, and as a result of which the liability for the firm would increase, and therefore, as we know the rule, the liability carry a credit balance. If it is increases, then it will be credited more. So as you can see, the journal entry for transfer of reserves and undistributed profits will be profit and loss account debited if it is having a credit balance, general reserve account debited if you have the general reserve also, then workmen compensation reserve account debited. Excess means the workmen compensation reserve is a specific reserve which is prepared especially to meet any uncertainty, to pay compensation to the employees. So after paying the compensation, whatever excess is left, only that will be distributed among the partners. And this reserve we will be discussing in detail in the upcoming video. Then investment fluctuation reserve account debited. The same logic. This reserve is prepared or kept so as to meet any fluctuations in the investment of the firm. So if there is any fluctuation, after meeting out that fluctuation, whatever excess amount is left, that is distributed among the partners. So these are the types of reserve which you might find in the question. There might be a reserve fund. So in that case, reserve fund will also be debited. That means while distributing the undistributed profit, any undistributed profit or any reserve will be debited in the entry to old partners capital or current account. What we will be crediting? Old partners capital or current account. As you can see the narration, being reserves and undistributed profits distributed among the old partners in the old ratio. Note, only the excess left after meeting the claim or obligation for workmen compensation and investment fluctuation will be debited and distributed among the old partners. Because workmen compensation reserve and investment fluctuation reserves are the specific reserves. That means these are prepared for a special or specific reason for which it has to be used. So after using it for that particular purpose, for that particular claim, if any excess amount is left, then only the excess amount is to be transferred to old partners capital or current account. If no amount is left after meeting the respective claim, then nothing will be distributed among the old partners. And if the entire amount goes for meeting the claim, that means there will be no excess. And if there is no excess, then nothing will be distributed out of these specific reserves to the partner's capital or current account. The second entry is for transfer of accumulated losses. The logic behind is all the losses have a debit balance. So when we are writing off the losses or we are distributing the losses, then it will carry an opposite balance because it will get closed. So losses have a debit balance. While distributing it or writing it off, it will carry a credit balance. And when we are giving the losses to the partners in their capital or current account, their capital or current account would decrease, which will decrease the liability of the firm. Therefore, it will be debited. So the entry for transfer of accumulated losses will be old partners capital or current account debited to profit and loss account. And profit and loss, which balance? Debit balance. As I was telling you before, that if there is a credit balance of profit and loss account, that means it is an accumulated profit. But if it is a debit balance of profit and loss account, then it is an accumulated loss. To deferred revenue expenditure account, then deferred revenue expenditure is also a kind of accumulated loss. In class 11th you have studied deferred revenue expenditure means those amount of expenditure or those amount of revenue expenditure which you have incurred at once. Maybe it is a very large amount or something. You have incurred it once, but the benefit derived out of such expenditure would last for a longer number of years. For example, advertisement expense on launching of a new product. Suppose if you have spent 10 lakh rupees on launching a new product at one go, but that 10 lakh rupees of advertisement, the benefit will be derived, let's say, in the upcoming 8 to 10 years. So that 10 lakh will be treated as advertisement expenditure, or we can say it will be a part of deferred revenue expenditure which needs to be written off year by year with the amount. So that is also a part of accumulated loss which needs to be distributed among the old partners in the old ratio. As you can see the narration, being accumulated losses transferred to old partners in the old ratio. Let us discuss a question on the basis of undistributed profit and accumulated loss to make it more clear to you. The question says, A and B were partners in a firm sharing profits in the ratio of 7:3. On 1st March 2016, they admitted C as a new partner for 1/6 share in the profits of the firm. They fixed the new profit sharing ratio as 3:2:1. So in this case, you are given old ratio as well as the new ratio. So you can calculate the sacrificing ratio by applying the formula old ratio minus new ratio. The PL account on the date of admission showed a balance of rupees 20,000 credit. So if credit balance of profit and loss account is given to you, that means it is an undistributed profit which needs to be distributed among all the old partners in the old ratio, the entry for which will be PL account debited, because it is an undistributed profit, therefore it carries a credit balance, but while we distribute it, it will carry an opposite balance to A's capital account to B's capital account in the ratio of 7:3. That is the old ratio. The firm also had a reserve of rupees 1,50,000. So reserve is also an undistributed profit. It will also be distributed among the old partners in the old ratio. So the entry for distributing this reserve will be reserve account debited 1,50,000 to A's capital account to B's capital account, and 1,50,000 will be distributed in the ratio of 7:3. Here the reserve is carrying a debit balance because generally a reserve is a kind of a liability and carries a credit balance, but while we are distributing it, it will carry an opposite balance. So we have two undistributed profit in this case, for which we have passed the entry individually, or if you wish you can pass the combined entry where the PL account debited will be 20,000, then reserve debited 1,50,000 to A's capital account to B's capital account, their respective amounts in the ratio of 7:3. Then C is to bring rupees 40,000 as premium for his share of goodwill. So the entry for bringing goodwill by C will be bank account debited to premium for goodwill account 40,000, and it will be distributed among the sacrificing partners in the sacrificing ratio, which we will be calculating further. Showing your calculations clearly, pass necessary journal entries to record the above transaction. And one more thing children, which I repeated in the last video, that before passing the entry related to the new partner, you have to settle the accounts of the old partners. So therefore, the entry for undistributed profit or accumulated losses will be passed before passing the entry for goodwill or cash brought by the new partner. So let us see the working note. First of all, let us calculate the sacrificing ratio, because this will be needed to distribute the premium for goodwill among the sacrificing partners in the sacrificing ratio. So as you can see, the old ratio of A and B is 7:3, and the new ratio of A, B and C is 3:2:1. So the formula for sacrificing ratio, as we know, is old ratio minus new ratio. So the sacrificing share of A will be old ratio minus new ratio, that is 7/10 minus 3/6. The LCM of 10 and 6 will be 30, and when we adjust the numerators according to the LCM, it comes to 21 minus 15 upon 30. That is, it comes to ultimately 6/30, and it is, since it is a positive fraction, it will be considered as sacrifice, because we have applied the formula for sacrificing ratio. Then the sacrificing share of B. His old share was 3/10 minus his new share, that is 2/6, and if we take the LCM of 10 and 6, it comes to 30. So when we adjust the numerators according to the LCM, it comes to 9 minus 10/30. That means when we deduct 10 from 9, it comes to minus 1/30. So as we have already discussed, a negative sacrificing share will be considered as the gain. So that means here A is sacrificing, A is the only partner who is sacrificing, and his sacrificing share is 6/30, or if we simplify, it comes to 1/5. That means only A will be getting the premium for goodwill brought in by C, and the entry for distributing premium for goodwill will be premium for goodwill account debited to A's capital account. Then B here is not sacrificing, rather he is gaining, and his gaining share is 1/30. That means he will have to compensate A with the gaining share of the firm's goodwill. So as you can see below, since B is gaining 1/30 in the profits, therefore he will also compensate A proportionately. And in order to calculate the compensation, as we have discussed in the previous videos, what do we have to do is, first of all, we have to calculate the goodwill of the firm on the basis of the goodwill brought in by the new partner by applying the formula goodwill by the new partner multiplied by reciprocal of his share. So the goodwill brought in by C is 40,000, his share is 1/6, the reciprocal of which will be 6/1. So 40,000 into reciprocal of his share, that is 40,000 into 6/1. So the firm's goodwill comes to rupees 2,40,000. Out of this rupees 2,40,000, B will compensate in his gaining fraction, that is 2,40,000 into 1/30. That means B will compensate rupees 8,000. So when B will compensate rupees 8,000, his capital will decrease, and because he is compensating A, he is giving more money to A, therefore A's capital would increase. So the entry for compensation will be B's capital account debited 8,000 to A's capital account 8,000. And if you wish, you can also, since A is getting two things, the premium for goodwill brought in by the new partner as well as the compensation. So if you wish, you can also pass the combined entry, in which you will be crediting A's capital account with 40,000 plus 8,000, that is 48,000, and you will be debiting premium for goodwill account debited 40,000 and B's capital account debited 8,000. So it is up to you whether you pass the combined entry or separate entry. But if the question specifically asks you to pass one single entry, then in that case you have to pass the combined entry. So this was the working note regarding the sacrificing share, then your gaining share, and the compensation to be borne by the gaining partner to the sacrificing partner. Now let us have a look at the journal entries. The first entry, since the new partner is admitted on 1st March 2016, so all the adjustment starts from that particular date. The first entry is for distributing the undistributed profit, that is the credit balance of PL account. So the entry will be profit and loss account debited 20,000 to A's capital account 14,000 to B's capital account 6,000. For accumulated profit transferred to old partners' capital accounts on the admission of C. Here what we have done, we have distributed the undistributed profit of 20,000 in the old ratio among the old partners. The second entry is again for distributing undistributed profit, or we can say the reserve. In that case, the entry would be reserve account debited rupees 1,50,000 to A's capital account 1,05,000 to B's capital account 45,000. That means we have distributed the reserves in the old ratio among the old partners. So the narration will be for reserve transferred to old partners capital accounts on the admission of C. The third entry is for goodwill brought in by the new partner. So the entry will be bank account debited rupees 40,000 to premium for goodwill account 40,000. So the narration will be for premium of goodwill brought in by C for 1/6 share. And the last entry here is for paying this premium for goodwill and the compensation by the gaining partner to the sacrificing partner. As we were discussing, you can pass the separate entries or the combined entry. Here the entry has been passed in a combined manner. So first of all, A, that is the sacrificing partner, will get the amount of premium for goodwill brought in by the new partner completely. He will be getting, because he is the only sacrificing partner. So premium for goodwill account debited 40,000. Then A will also get the compensation by the gaining partner, that is B, which we have already calculated as rupees 8,000. So B's capital account debited 8,000 to the sacrificing partner, that is A's capital account 48,000 in totality. The narration can be premium for goodwill brought in by C credited to A along with 1/30th of the goodwill to be contributed by B due to gain in his profit sharing ratio. So these were the journal entries related to this particular question and the topic which we have discussed in this video. I hope the topic discussed here and the question as well is clear to you, children. This is the assignment based on this part. You have to answer the following questions in your register. Question number 1, you have to redo the question taught in this video. Then question number 2, you have to give the journal entry for distributing accumulated profit and reserves in case of admission of a new partner. The entry for this will be undistributed profit account debited or reserves account debited, or we can say general reserve account debited, profit and loss credit balance account debited, reserve fund account debited to old partners capital or current account. Also state the ratio for distributing it. So the answer to this will be, this reserve or profit will be distributed in the old ratio. Question number 3, give the journal entry for writing off accumulated losses in case of admission of a new partner. Also state the ratio for writing it off. So the answer to this question, the entry here will be old partners capital or current account debited to accumulated losses account or to advertisement expenditures account or to profit and loss account debit balance to deferred revenue expenditure account, and it will be written off in the old ratio. Question number 4, you have to solve practical question number 39 from the chapter Admission of a Partner of Accounts book by D.K. Goyal, volume 1. So go through the video once again, revise the question done here and also redo it on your own in your register. In addition, complete all the written work in your copies, children. Revise all the formulas, go through all the parts so that it is easier for you to practice more and more questions. Thank you, children.